All right. So quite often, randomly throughout a day, I'll get a chat from you with some picture or some line or some article or something. And this wasn't just a few days ago. You sent me the Dow 100 Dividend Index.
Yep.
And just before I had what? You said, here's the whole thread or something like that.
Yeah.
And it was pretty fascinating. You know, I knew this index existed. And if you're not familiar, the Dow Jones 100 Dividend Index is an index that just tracks a specific set of dividend stocks, which changes
100 of them.
Yeah, 100 of them, and it does change based on the criteria.
Correct.
And it was pretty cool, and that's why I wanted to do a show about it, because there's so many similarities. Not necessarily how this index is not anything related to what we do. To how we've kind of created our own portfolios. Yep. I think it's a good bit of teaching that we can help our viewers, because there's a lot of structured thought in what we can discuss here. So first of all, let's dive in a little bit to this index. Like, what's it designed to measure?
I mean, it's really about high quality, high yielding, dividend paying stocks. They're not as concerned about the growth of dividend like we are. They're really just trying to target what are the best 100 stocks
that fit into this criteria.
Fit in to this criterion, and the main criteria is they're paying a high yield. You know, they're going to have a
consecutive increases of 10 years.
Pretty good track record of increasing, though not, they're looking at 10 years, I guess. They're also going to be some of, you're going to recognize these 100 more than likely.
Yes, there's a lot of strong popular names in there. Right. So the initial screening for putting this index together is, some of the largest U.S. stocks has to be in the U.S. They have to have paid for 10 consecutive years of payment, not necessarily increasing, just paying 10 consecutive years. They want to look at some fundamentals. So there's got to be a really strong free cash flow to debt ratio. They've got to have a return on their equity. So the investments that they have outstanding have to have some positive yield on there. And there has to be a dividend yield. It doesn't give a percentage of what they're looking for.
But it was just saying that it needs to be above the median, so above the middle. So you've got to be, the higher payer.
Yes.
You can't be paying pennies like.
And then when they look at this screening, they pick the 100 top, the 100 best that have this filter. There might be some other little nuances in there, but the reality is they have a screening methodology.
Yeah. And to me, that was why I sent it to you. I just thought it was fascinating to see, this Dow Jones, when you're first starting to get into investing or you're a kid, you're like, everybody knows the Dow Jones Industrial, or at least you've heard of it. So it was just fascinating to look at how an organization like that, what are they looking at whenever they're trying to select the companies that go into this top 100?
Yes.
So it was cool.
Well, where it peaked kind of my thought process it was really twofold. First, and probably most importantly, they had a methodology, a planning process of how they were going to put this index together. So like the S&P 500, the gold standard of every index out there, their methodology is really one thing: the 500 largest companies in the world.
Based on market cap.
Yeah, based on market cap.
Which is just
so stupid.
Yeah.
And yet we look at this as it's the S&P.
It's the gold standard.
The standard is they have to be a large market cap company. That's it.
It doesn't have to do anything with profitability.
They don't have to be, it's the 500 biggest, and it's returned great. There's indices that can do better, but the reality is the methodology behind it's just not sophisticated at all. There's no thought process. It's just size matters. And then on the flip side, you have an index like this where you've got a really strong methodology of the selection of these stocks that can come in here. And that is very similar. We've been doing this for years and years on our own portfolios. Mm-hmm. Ours go a lot deeper because there's a lot more to track in what we're looking at. And it's, the 10 years that's a good start.
Right.
You know,
Yeah.
I think it could be a lot stronger.
But that's just
and
10 years of paying.
Yeah.
It could be all over the place.
And then you can also have, the consecutive increases. We can look at free cash flow a lot deeper than this, than just it's how it's connected to its debt. How much debt does it have? It's related to its competitors.
Mm-hmm.
Dividend yield. You can have your payout ratio. How much of their free cash flow are they paying out in dividend? How many shares are outstanding? And we can go on and on and on. There's so many amazing things that you can build. But the thing I love about this is they did it.
Mm-hmm.
It's more than, how many companies out there, have a larger market cap than X. This indice they put some thought into it.
That's right.
It's not the greatest indice. This is why dividend stocks probably have a bad name, because they look at this indice and, well, it's underperformed the S&P by 3% a year historically. Oh, well, dividend stocks are way worse. Well, this indice isn't the greatest, but I can show you track records of dividend stocks that crush. I mean, dividends as a whole,
yes.
if you do the S&P thing to it, where it's like, as long as it's a dividend, it's included, crushes the S&P return.
Yep.
If you just don't even filter anything out, just put them all together, the historical return is it beats the S&P by 4% a year. I mean, it's not even close.
It's crazy.
So when you start putting filters around it, filters can be really good and they can be really bad, depending on what filters you put in play.
That's right.
I would say to put filters in play is very strong. Like you definitely need filters. You don't want to be buying garbage.
Correct. Yeah. I mean, because that way you, like it says, the whole goal of this was to eliminate companies that have a unsustainable dividend paying. This filtering focuses a little more on profitability and cash flow, which is great. That's what you want. You don't want it to just be strictly based on market cap or what their 52-week high is.
So that also relates to planning. When we sit down with clients, we have to have a baseline, something that we can go off of. We use Simplicity for that. And it has something in it called the base plan. It's where they are with no strategy, just what's the problem? What are we actually trying to fix? So this industry is like, what are we trying to measure? Like what really matters?
Yep.
And there's all these fundamental screenings that they go through in their methodology to help discover what they're actually trying to measure in the form of this indice. Well, for Simplicity, we do the same thing.
Yep.
So this logic applies like across the spectrum of so many different things, right? If you're going to build a building, you got to start with the foundation, right?
Say, yeah. So and you better have a blueprint
of what you're going to build.
Of what you're going to build.
Yeah. So when you're heading into retirement, you got to start at the foundation, have a blueprint of what you're trying to solve,
what your income plan,
income plan, and when you're putting together a portfolio, the same things apply.
That's right.
And I guess the whole point of this discussion, we're using the Dividend 100 as the platform, but the reality is there's methodologies that go into.
They've got a plan.
Right? They've got a plan
to identify what are those top 100 dividend paying companies for this year, because they do rebalance it each year. It's not a stagnant indice, which I also found fascinating that they only look at it once a year, which is interesting.
Yeah, and we look at ours all the time.
Correct.
And we're always open to making changes throughout the year. But the S&P, all indices pretty much just make a change once a year.
Which is just interesting, because we get asked a lot, how often are you changing positions? And
as needed.
Yeah. Which is
we look all the time. We love those meetings where we get together and, here's all the different things that have changed and what are good, what are bad, what should we change, in our own portfolio versus the ones that are always on our watch list. And other opportunities, and there's a lot changes on a day-to-day basis, a minute-to-minute basis. Yeah. So as a manager, I think the most important trait is patience. Yeah, because sometimes I think you can get ahead of yourself very quickly and panic. The volatility doesn't hurt people; panic does. Mm-hmm. And when you're in the right frame of mind and you see what's happening around you, you have to understand: does what's happening around me affect the individual positions that we own? Mm-hmm. Now, the price can be affected in that day, but is this a short-term thing or a long-term thing?
Right.
Is the CEO doing some crazy stuff? Versus the industry is getting hurt by X.
Right.
So you have to look at what's actually taking place to understand, is this a movable action? Like, do we need to take action because of the movement that's happening to a specific company, or is this just something that's generic?
It's more holistic.
And the Div 100 for the Dow, they're just looking at once a year. It's a math equation.
Sure.
Fits into this.
But they still have a process, right? Which is great. Which is like, even when the patients, you still have a process to even get to replacement company. Or does this one need to be subbed out? Or is this one on the watch list? Like, you still got to have your filters, right?
Yes.
You got to have your plan. You got to have your strategy around it.
And the another thing that was in your original chat was this ETF. I think we've talked about it one or two times on different shows. It's a Schwab dividend ETF. It's probably one of the most popular out there. I think its asset base is gigantic of how much money it has inside of it.
It's wild.
And it's probably one of the best, if not the best, dividend ETF.
Yeah, especially if you're just like a do-it-yourselfer and you're wanting to kind of dip your toe into this dividend and you don't even know where to start as far as like building your own portfolio where you're actually going to buy specific companies. It's a great one. They do a really, really good job at even showing you like what are our top 10 holdings and how they manage that. But it pays out a pretty good dividend.
And it has increased its dividend almost every single year. I mean, there's a lot of similarities in what that ETF is and what we do. Our numbers are significantly better, but the reality of what it does, we like it.
Yes.
We don't use it. I would never put it in anybody's portfolio on purpose. Because we manage the same, like we're a competitor, but if you were out there and you didn't know what to do and you didn't have somebody that had a good portfolio of dividend stocks, it's not a bad alternative. However, I like the Berkshire better. It doesn't pay out a dividend.
Right. This at least pays the dividend that you
this
can
one
reinvest.
you can take out the dividend, you can reinvest the dividend. It doesn't work. It's not the same as owning direct stocks. Right. It is an ETF. It's similar, but it is not the same.
Right. Yeah. You still need to do your research on it. So we're not recommending it by any means, but it is an option.
And the reason why we're talking about it is it's based on the Dow 100.
Right. Basically, if you wanted to, and I don't know if you could actually buy the Dow 100.
Well, you can do it in the form of this ETF.
That's what I was going to say is like, this is an option. If you like what we've said about the Dow 100, you want to do it yourself. Like, here is a vehicle that you can invest in.
Yeah. And again, we are not condoning or recommending, this type of structure. I just love, I love the fact that the Dow 100 has a methodology. We've been using methodology for over a decade on how we manage our portfolio. And, this Schwab ETF is modeled off of the same thing.
Yep.
I think it could be done a lot better. We've done it a lot better, but these two are connected at the hip. But I think the most important takeaway here is the fact that there needs to be a plan.
Yeah, you got to have a plan. You got to know where you're headed, where you're wanting to go, and where you are, most importantly. Yeah, we have a lot more information on planningmadesimple.com where we talk about all kinds of things, dividends, tax advice. What else? I mean, we've got articles that are popping
retirement,
up every
income
day.
investing.
Yeah, so that's just a great resource, planningmadesimple.com, for you to kind of continue the conversation. And as always, if you have any questions or need anything, we're here to help.
Awesome. Hope you enjoyed today.